Hello, everyone. Welcome to this new Economics 101 presentation. And this time we'll have the spotlight on inflation. So let's get started. Inflation, what is it? So the Bank of Canada defines inflation as a persistent rise in the average level of prices over time. So more concretely, when you look at the news, you hear about the rate of inflation that's measured by the increase in the price of a representative basket of goods over the past 12 months. So we look at inflation on an annual basis. And finally, the price of this basket of goods is measured by the consumer price index. So a lot of concepts here. Let's make this very, very simple. So concretely, Statistics Canada, what they do is that with surveys, they follow the consumption habits of Canadian households. They look at what people tend to buy. They build a basket of representative purchases every single month, and this basket tends to be revised regularly, so they have an idea of what we consume typically as Canadians. And then on average, around 97,000 prices are collected each month to produce the CPI. So they measure very granularly the movement of the prices for all of these goods that are in the basket that consist the CPI. So the CPI more concretely right now, well, at least in 2020, it was close to 30% made up of shelter costs. Food was 16.4%, transportation 15.3%. And then you trickle down all the way to clothing and footwear, which is about 4% of the typical consumption of a Canadian household. So this is how they build the CPI. The CPI has been around for a long time. So here from Statistics Canada, we have data for the last 100 years for the CPI. So that's the price of the basket. If you look since 1920 all the way to 1970, it looks like it was really stable. After that, you had an explosion of inflation in the 1970s, caused mostly by the oil embargo. And since then, we've had stable inflation all the way to today. So this is the CPI. As I said, it looked stable between 1920 and 1970, but when we bring it all back into the inflation figures, so as you can see, it was all but stable inflation rate between 1920 and the 1950s. Some periods of minus 15, plus 15. So it's very hard for businesses to plan ahead when you have this much volatility in inflation. That was a concern. And in the 1970s, the oil embargo created an environment of high inflation. So that brought central banks in. So the Bank of Canada in 1991 installed the target of 2% on inflation. So it means it's still going to be volatile, but within a well-defined band. So inflation is more manageable, more you can anticipate it more if you're a business looking to invest or an household looking to buy a big ticket item. So where does inflation come from? So here, the three main causes of inflation. There could be some other definitions, but here you have demand pull, number one, which is in the example here, Mr. is selling sneakers here. He used to sell them at $100, but there's just so much demand for sneakers that he can raise the price to 150 and still sell all of these sneakers and make more money. So that's when demand for goods and service exceeds production capacity. We tend to see that at the end of business cycles when the economy is running hot. So you have some demand pull inflation going on. Cost push here rings a bell with the 1970s oil situation. So Mr. sells balloons here for $5. He puts helium in there. Used to cost $10 for a can. Now it's $20 for a can of helium. So that means he has to raise the price of his balloons to $10. So that's production. When production costs increase prices, again, echoes of the 1970s. And the built-in inflation is the most common source of inflation. So when prices rise, wages have to rise too. So in bargaining agreements between workers and employers, there's a contract where it says, well, I want to be protected against inflationary pressures if I am a worker. So I want my salary to rise every single year to protect me from inflation. So after that, the business goes and says, well, I need to raise my prices to be able to pay for that. So it's kind of a self-feeding loop here of inflationary pressure that is built in from this negotiation between employer and employee. So these are the economic concepts. Now, when we look at the markets, the asset class that is the most impacted by the ebbs and flows of inflation are interest rates, but most importantly, the asset class is the fixed income, so bonds. So rising inflation pushes interest rates up and bond prices down. So always remember the drawing on the bottom here, the relationship between interest rates and bond prices. It's really a balance like this. So when you have higher inflation expectations, that leads to higher interest rates. So if interest rates rise, the price of bonds will fall. And if interest rates fall, the price of bonds will rise. So this is exactly the dynamic here. So when you expect more inflation, interest rates will be pushed higher, and that pushes the price of bonds lower. So that's the most important aspect from the most important impact of inflation on financial markets. Looking at stocks, it's not as clear cut as it is for the fixed income market, for the bond market. So if inflation is not too high, because when inflation becomes too high, that brings some volatility to the markets. But if it's not too high and it's accelerating slowly, well, it can act as a support for the stock market. So when we look at the three pillars here of market valuation, well, the first one would be the dividend yield, not really impacted by what happens with inflation in the short term. But the second pillar is earnings growth. And this is where you can have an impact. Again, it's not as strong an impact as on bonds, but if you have a higher inflation, that means that businesses will be able to have more pricing power over time. So they'll be able to sell their products for a little bit more, or grow their earnings a little bit more too. So that acts as a support for equities. Again, it's not as direct as for fixed income, but that would be still a net positive. The third component would be the expansion of contraction of the price earnings multiple. So this is something else. This has more to do with the risk on, risk off kind of risk appetite going on in the markets, less impacted by inflationary pressures in the short term at least. So that's it for inflation. So ia.ca/economy is your go-to webpage if you want more of these economics 101 presentations. You'll find them there. Thank you, everyone, and we'll see you next time.